This is a Hot Pie Media original.
The contents of this podcast are for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
Hi everyone, welcome. I'm excited to welcome Gershie Vann, who is joining us from Chicago, Illinois. He's the founder and CEO of Magma Capital Funds, a multi-strategy quantitative hedge fund manager focused on utilizing volatility indicators to strategically allocate to varying asset classes. Hey, Gershie.
Ash, pleasure to be here.
Thank you. Thank you for joining us today. Myself and our audience are really excited to learn more about your really impressive background and the company that you have recently established. So your background is really unconventional. As for a hedge fund, typical hedge fund manager, you grew up in LA as the son of a rabbi, working in business intelligence for healthcare companies, and then started this amazing AI multi-strategy fund at the age of 25. Wow. What are you going to do when you're going to be older, when you grow up?
Yeah, there's lots of dreams, lots to do beyond the hedge fund world also. But, you know, I think when people think of a career path, they try to look at some linear narrative where it's like this person does this and then this and then this. But I think we all know in our life, there are events that cause you to go on this path or that path. And, you know, one slight something can, you know, lead you off on some other route. And I think what one needs to come back to is kind of who you are, what you're good at, what drives you, what motivates you. And, you know, from when I was young, I was always driven by both entrepreneurship and a desire to understand systems that we exist within, specifically systems that aren't readily apparent. So the monetary system would be an example where, you know, the Federal Reserve, somebody in some room in Washington, D.C., makes some decision to set interest rates, and that dictates whether or not we buy cars, how expensive the cars are, mortgage rates, and which houses we buy. Like even over the past couple of weeks, you could see a large drop in refinancing, a large drop in the types of houses that people demand. And so for me, you know, the ultimate way to bring together entrepreneurship and a love of systems, a love of macroeconomics, I studied finance in my undergraduate degree, was to start a hedge fund. I suppose, you know, the conventional route would have been to go work at a hedge fund for 10 years and maybe I would have learned a little bit more, made less mistakes had I done that. But I think when you have a beautiful idea, you have something that you think you can contribute to the world, you want to do that, even if it's going to be a little difficult.
Wow. So it's not just your background that's really unique and your personality, which I've got to know you and really I'm always so impressed and amazed by what you do as an individual and as a businessman. And later on, we'll also talk about some of your impact vision that you have. So in addition to yourself as a really special founder and entrepreneur, also your fund is a really unique proposition in the hedge fund world. So it will be great if you can share more on that with our listeners.
Yeah, sure. So one of the things I think that we're doing a little differently is the typical approach to constructing a portfolio is to really focus on what's happened over some period of time to optimize exposure based on that period of time. So for example, if let's say someone is looking back to the 1970s and they're going to invest in the S&P and in, let's say, some mix of bonds, so corporate bonds and treasuries, they'll optimize the exposure over that time period, and then they'll have some static allocation. But what hit me pretty early on, which really sparked the whole thesis and, you know, this discovery journey, was that if on a daily basis you tried to achieve the optimal allocation, so meaning, let's say the optimal allocation over a 40-year time span is a 60-40 portfolio, but on a day-to-day basis, it deviates quite a bit from that 60-40 portfolio, then you could, if you could achieve that daily optimal, you could get a substantially higher yield on your return, a substantially higher yield on your investment without increasing the risk profile of that investment. And so it'd almost be like creating a better index. And so that's what we're trying to do. We're trying to build, an investment thesis that will allow you to, invest in the same instruments that you're already investing in, the S&P, the Dow, the NASDAQ, and then treasuries. On a typical day, we're like 60% treasuries, 40% equities, but will allow you to achieve 2x or so of the yield of a typical index.
Mm-hmm. So how is the AI that you developed assisting in portfolio selection and really determining the optimal investment for the day, taking into account market volatility, price data, and statistics?
Sure, yeah. So, I think we get used to making rapid fire calculations in our mind and not even being aware that that's happening. That's how, intuition works. You synthesize all of the different data that you've come to recognize are indicators of whatever it is that you're trying to analyze and make a decision based on. And then you make a snap decision. I like to use as an analogy if, say, you were raising some money for some charitable cause and you met someone and you were trying to size them up for what type of donation they could make. You might look at certain markers, like what type of watch they're wearing, what type of car do they bring to the event. And those are all features. Those are all signals that tell your brain, this could mean that this person could write a $5,000 check or a $18 check, right? And so you use all these different things to kind of form a vision. And it's similar with financial markets. We're building machine learning models, neural networks that can look at different data sets, specifically data sets focused on volatility, price, and sentiment, where we'll isolate those. That's kind of like the secret sauce, if you will. We'll isolate those data sets. You test them to kind of make sure that they have predictive capacity, and then you feed them into the neural network, into this machine learning model, and it then trains on those signals to learn to make better decisions.
Mm-hmm. And some investors hesitate to invest in quant hedge funds,
Sure,
because it's really kind of based on the AI, and there can be a failure. And it can be a bit frightening. So how do you overcome those challenges when, running the AI?
Yeah. So I think there's two things to think about here. I think, first of all, people get very nervous when AI starts getting used as general intelligence, because AI at this moment in time is actually quite poor at general intelligence. You can interface your computer could be very, very good at making some very complex calculation, but it's probably not great at having some type of, emotional, philosophical type conversation if you're feeling lonely. It's not designed for that. And so what we do is it's a very, very focused machine learning model that we built out. The portfolios that are constructed are based on fundamental indicators. So meaning what we'll do is we'll divide volatility down into quartiles, and then we'll optimize our exposure to the assets that I mentioned before, the S&P, Dow, NASDAQ, and then treasuries for each of those quartiles. So the portfolios that have been constructed are not based on AI; those are based on just logic, right? Like look back at the past whatever time period, past 15, 17 years, build an optimized portfolio based on those past 17 years. The structural play of what's happened over the past 15 years, what happened in 2008, what happened in 2020. Maybe there won't be a pandemic exactly like what happened in 2020, but we know that, let's say over the next 10, 15 years, there'll be some crisis. And what happens in a crisis is people get very nervous and they pull money out of risky assets and they put it in safe assets. And so that cycle, which happened in 2009 and which happened in 2020, those cycles will continue to play out forever. And so we built those buckets, and those are just based on macroeconomic fundamental type cycle knowledge. The AI is just designed to make the decision of, is it bucket 1, 2, 3, or 4 today? And so it's very, very, hyper specialized knowledge set. And then I guess what I would say also to an investor who's very nervous about any sort of black box is that you already use AI in your life. If you're driving somewhere, you're making any type of optimized decision, you're probably using AI. And when someone pulls out Waze or Google Maps and or they ask Google some question, they don't get all nervous about the answer that Google gives because Google's a black box. They're fine with it because they've grown to kind of trust it. And we're at the beginning of this transformative wave of people, going from discretionary investing where, we have grown to rely on humans making investment decisions, and we're comfortable with that. But we're reaching the point where there's enough information out there that machines will start over the next couple of years making substantially better decisions. And I get it that people are nervous about it, but just think about ways and maps and those types of things.
So how do you believe AI is gonna reshape or influence the hedge fund industry? Is it gonna replace traders?
Yeah, I think so. Yeah, I think I don't think that humans can process enough information to outperform AI. At the moment, maybe they still can continue to do so, but I mean, you can just look at the percentage of trading that's done by AI rather than humans. I think at this point, the vast majority of trading on public exchanges is done by AI models. Maybe maybe humans will be able to spot certain like dislocations, but you're talking about at the margins. I think the majority, if you look at the largest hedge funds, the smartest money, quote unquote, if you will, they're quant funds.
Yeah.
They're running enormous amounts of money. They're pouring billions of dollars into research. They're approaching AI the same way Google approaches AI. And so I think we're really like on the cusp of a revolution. It's hard to see it if you're 60 or so. Well, I don't want to be mean to a lot of the money in globally is managed by people that grew up in a world where humans were the people that ran the money. And there's this shift happening. And I think it's healthy to kind of step back and like evaluate the shift and honestly appraise whether or not that shift is likely to make things better or make things worse. And I think in most instances, it will make things better.
Mm-hmm. Yeah, we hope so. And you recently created a new class share that offers a hybrid equity income structure with an annualized 12% dividend and half of the trading gains of the underlying strategy. So tell us more about this unique new asset class and what type, share class, and what type of investors in this is this offering most appealing to?
Sure. Yeah. So we should probably come up with some fancy name for it, but it's just called Class B.
It should, it makes it sound like it's not as good.
I know. They should call it like enhanced yield or something like
yeah.
that. Something a little bit fancier or more exciting. So we recognize right now that there isn't much of an offering of yield out in the marketplace, which gives us an opportunity to kind of offer a product with yield. And so then we have to ask the question, okay, so why would we pay a fixed yield of 12%? We recognize that we're a new fund. We've been trading for about 16, 17 months. And we recognize that for investors, making an allocation at this point is them taking a risk, expressing trust in us. And we want them to know that, we strongly believe that we can deliver returns of 20% per year. But we're okay if you don't yet, feel so confident in that you're willing to move forward. So we'll pay you a certain fixed yield, 1% a month or 12% per year. And that way, irrespective of what the fund delivers, you have, the return that you're looking to receive. And so say in the event that there is a 20% return of the underlying strategy, somebody would receive their 12 plus half of the 20. So they'd wind up with 22. And for us, this isn't, a share class. Usually people get confused with this and they're like, wait, this is too good to be true. Because how could you be paying me so much money if you're not making your money? We don't break even until we're at 24%. It's not about that for us. It's about, growing from 5 million to 25 million. And so we're willing to, this is a share class that we're opening up to 20 million, and we're going to pay dividends for 24 months. And we view this as a way to kind of, acquire goodwill, acquire customers who will then become LPs, for the life of the fund as things play out over the coming decades. And so if we end up paying out more than we get from performance fees, totally fine.
That's nice. I like this model.
Yeah, I mean, I think it's uncommon in the hedge fund industry, but it's very common in other industries. Like, when Uber Eats comes into some town and they want to get you to use it, they give you a free delivery, right? So this model of, kind of pushing some gain towards the customer so that they make a decision to move is fairly common.
Right.
It just seems like the hedge fund industry isn't very keen on being innovative.
Yes. Great way to build the trusted relationships with new clients, with new LPs.
Yeah. I think one thing,
some dating before you get married.
There you go. Yeah. It's also something, I think there's something that's that like establishes trust in getting a wire every single month. Because that's what we do. Somebody, let's say you were to make $1 million investment, we'll wire $10,000 every single month to your account. Obviously, and that's like completely aside from the principal. So it's a way to, establish that relationship in like a deeper way than would normally be established.
Yeah. And you are not just innovative on that front. Also, you launch a fund that caters to super athletes, which, as we talked about it. I don't remember the exact numbers, but the research shows that many of the professional athletes go bankrupt within a few years after they retire. So you have a great kind of financial solution for that segment of the population. And it would be great to hear more about that. And you also have a very well done, beautiful software that is super transparent, so the investor can see like real time what's going on with the trades and their money and the performance, which is another great tool for your clients.
Yeah. One of the main things I think that the hedge fund industry doesn't presently have is transparency. Funny enough, I think there's a regulation that's winding its way through the legal system that would force hedge funds to issue quarterly statements to investors. So the most intense law would be that you have to tell your investors once every 3 months, how much money they actually have, which I think is ludicrous. There should be a way for an investor to see every single day exactly what positions they're holding. And that's one of the nice things about what we're doing. Our intellectual property doesn't lie in, what assets we're holding. I'll tell everybody we trade the S&P, the Dow, and the NASDAQ, and these treasuries. And I'm happy for every investor to see that this is exactly what they own every single day. And this is the value of their account every single day. That creates this transparency, and it forces us to be honest with the investor. So that's one of the things. Regarding the athlete fund, for me, this was a little bit of like a passion project because as a child, I think children dream as far as the people around them. They dream as far as like the person the person that they know that got furthest. That's how far they dream. And so if you grow up around people who are overachievers and who are very successful, be it materially, spiritually, socially, whatever it is, then you're going to think that that's possible, right? I was fortunate to grow up in Calabasas, and it was this very affluent community, very like work hard, be successful type community. And so, ingrained in my psyche is like hustle and you'll make it.
Yeah. And a great example, I was a huge fan of her growing up, Britney Spears. That was one of your neighbors.
She was a neighbor. Yeah. there were plenty of famous neighbors, and it gives you a certain confidence, a certain chutzpah, right? To like go out and actually.
For those who don't know what's chutzpah.
Yeah. So Ash is very familiar with this because she's Israeli, and like the definition of being Israeli is having chutzpah. I think
that's
chutzpah
why
at this point
I moved to the US.
Oh yeah. Yes. I think at this point chutzpah is like an English word.
Yes.
But basically it means like having the audacity to do something, to whether it's to like scream at your parents, or that would be like a bad manifestation of it, or to like go against the grain and, to to swim upstream, to do something, even though everyone is doing something different, because you think it's right, and to change the status quo, to be a leader. So, in the context of athletics, what's always bothered me was there's some kid in some tiny town in Ohio, and the only person that makes it out of that town and becomes something is some athlete. And now that little kid who sees that athlete is like, oh, I can accomplish big things, whether it be in athletics or in science or whatever it is. But then what he sees is that same guy, he gets in the NFL and you can watch him in the Super Bowl or, whatever games he's watching. And then 2 years later, he's back in town. 3 years later, after this NFL player retires, he's back in town and he's selling used cars. That's terrible. It's a travesty. Now that kid, his how high he's going to dream has been ramped down substantially. My vision for a lot of these athletes is that they're stars on the field and they should be stars off the field. They carry with them, stardom comes with a certain responsibility. It comes with, there are people that look up to you. And if you can kind of live up to those expectations and be the star that these children want you to be, then you can really, really change communities. I think that's why when we see athletes go and let's say a lot of the stuff that LeBron James has done off the field, it really lifts you up because, you're like, I can connect to this and, soar closer to the stars. And I think we should be able to do that for many, many more athletes. And one of the ways to do that is to stabilize their financial situation. And what struck me pretty quickly was that tier 1 athletes were doing very well. Steph Curry, LeBron James, Kevin Durant, a lot of these guys are already in VCs. I mean, they're basically their own family offices, and deals kind of flock to them. But if you're a tier 2 or tier 3 athlete, even though you're making pretty good money, and if you were, let's say, if you were a doctor in the United States, you'd have pretty good financial products that were put in front of you. If you're a tier 2 or a tier 3 athlete, you probably don't have such great financial products being put in front of you. Maybe you're investing in a pizza store or something, which isn't the best investment. Sometimes it does well, but usually. So, we set out to build a hedge fund, to build a systematic, liquid, uncorrelated strategy that would give athletes exposure to the entire US economy, financial planning tools, and that type of thing, all within kind of the Magma platform.
Oh, that's really inspiring.
Thank you.
And for those of you who are into sports and see some partnership opportunities, it will be really interesting to explore. Yeah,
we always welcome all conversations with any providers in the space. We tell a lot of athletes also that we have no interest in running 100% of your money because that's not in your best interest. We want to run, let's say, 10%. But there's so many other partners that need to come in here to kind of fill out this picture, VCs and PE groups and general wealth managers and that type of thing. And so we started collaborating with a lot of them because it's only by working together that we're really going to get to where we need to go.
All right. For those of you who don't know, I used to compete in ultra marathons, but unfortunately, it's not your target audience because the ultra runners don't get paid. So we do really hard work, but just kidding. I am sure there are athletes out there such as the NFL, soccer, and others that would benefit a lot. So last but not least, one of your future goals and dreams that you're extremely passionate about is a really great impact cause is to build a fast train to connect the Midwest. So it will help millions of Americans gain access to more job and career opportunities. So it will be great to hear more about this wonderful vision of yours.
Yeah, I'm happy to talk to it. I will say I haven't done the research necessary to turn this into a business just yet. It strikes me though that proximity to opportunity is one of the main barriers to people's success. And so within a fairly short and within a fairly small radius, you could have certain people who are making half or a third of what people within a different, city are making. And the only reason why, this individual here who's a plumber is making X and this individual here who's a plumber is making Y is just because they happen to live in different cities. And so,
but also the cost of living.
No, yeah. And so but again, remember, so let's say like over here, is Chicago and over here is Columbus. And so the cost of living, let's say, is a little higher in Chicago than it is in Columbus. And so you get paid a little bit more. But if that person were to commute to Columbus, via a bullet train, and he can get there, let's say,
make more pay less.
He or she, yeah, exactly. And then move back. And then maybe the costs would go up a little bit in Columbus. Maybe the costs would go down a little bit in Chicago. But the equilibrium that would be reached would be better for all people. You'd have more people participating. And I think there's a lot of cities within the Midwest that have, they're on the mend. They've been hit over the past like 30 years. They used to be manufacturing cities, and now they're kind of finding their way into the new reality that is the modern world, where manufacturing is really not done locally. And I think for them to be able to access a wider range of opportunity, just through transport. I mean, this isn't even like a revolutionary idea. Like
Right.
You go to Japan, they have it. This is just an instance where it seems to me government hasn't done what it's supposed to do. Government hasn't stepped in and created this transport system that will allow people to go from Columbus to Chicago in, let's say, less than an hour. That will allow people to go from Cleveland to Chicago, from Detroit to Chicago, from all these different areas where, like, in many like large cities, right now, there are not enough people for all of the jobs that are needed. And then there are other cities not too far away where there are not enough jobs and there's too many people looking.
Yes.
So it seems to me to be a
Big
very
gap.
simple solution to just match opportunity,
Right.
simply by building a train with tech that already exists. Like the solution, in my opinion, isn't to, develop some new vacuum tube technology, and build like a Hyperloop. Like a Hyperloop is awesome. I think we should build it, and I think it'd be really cool once it happens. But like, I don't think we need to like completely reinvent the wheel to solve this problem. The trains already exist.
Yes.
So
It's a good point.
Yeah.
I should start lobbying for this project.
I think the solution to this will have to come through the private sector, not
Yeah.
through the public
Right.
sector.
Yeah.
It seems to me the public sector has become more focused on managing laws that have already been passed rather than like embarking on new projects.
Yeah, we need more innovative, inspiring young entrepreneurs like Gershie here
Well.
to work in the public sector and push society to advance and flourish. So it was such a pleasure interviewing you, Gershie. Thank you so much for joining our episode today.
Thank you. Yeah, it was nice to be here. I appreciate it, Ash.
And I look forward to learning all about the next ventures and the next funds, and to see you soon, and to see you guys soon at the next show. Thank you so much for listening.
Thanks for listening. You can find more episodes and all of our other Hot Pie Media originals baked fresh daily at our home online at hotpiemedia.com, the Hot Pie Media YouTube channel, or wherever you listen to podcasts.